Getting a mortgage is one of the most important financial decisions that you will make in your life. That's why it's critical to know what options are right for you, but I'm here to make it a bit clearer. So let's jump in. Here are the different types of mortgages and what it takes to get each of them. Let's start with the conventional loan. These loans are the most straightforward because they are not federally backed. Conventional loans come in two flavors, conforming and non-conforming. Conforming loans meet certain standards that are laid out by the Federal Finance Housing Agency. Non-conforming don't. This is typically due to the higher price of the house or an unusual situation on the part of the borrower. Conventional loans are good because they can be used on primary, secondary, and investment properties. I currently have a conventional loan on my investment property, and the whole process was pretty straightforward overall. If you want to know how I got my investment property with no money down, drop a comment and I'll explain in a future video. While the interest rate on a conventional loan is sometimes higher than other loans, the overall cost can be lower. More on that later. You can avoid paying private mortgage insurance if the equity in the house is 20% or higher, which usually comes from a down payment or paying the loan down over time. One of the major drawbacks of a conventional loan is that it usually requires a hefty down payment of 20% to avoid PMI. With the median home price in the US sitting at around $430,000, your down payment would have to be a whopping $86,000 to avoid PMI. That's nearly twice the median annual salary in the US. On top of this, you're required to have a debt-to-income ratio below 43% and a minimum FICO score of 620, which to be fair is below the average, so that shouldn't be a concern. The documentation required is also extensive, which can be a nightmare to gather. All that being said, the conventional mortgage at a 30-year fixed rate is the best choice for most people as long as you can afford the PMI or have a huge down payment. Next is jumbo loans. These are a type of non-conforming loan that's most common in high-cost areas such as LA, New York, and Hawaii. The main draw of these type of loans is that you can borrow more money to buy a more expensive house. Despite the high amount borrowed, interest rates tend to be in line with the conventional loan. Like the conventional loan, you'll still be required to make a down payment of 20%. Since jumbo loans start around the $650,000 mark, your down payment could easily be in the six-figure range. A higher FICO score of around 700 is a minimum as well, along with a DTI no higher than 45%. Often for these loans, the borrower will need to show significant assets as well to mitigate the risk to the lender. This means even more documentation than the conventional loan. If the house you're looking for exceeds the conventional loan limits, a jumbo loan is likely the right option for you. Next, government-backed loans. While the US government isn't actually a mortgage loan business, they do work with lenders to ensure Americans have access to home loans at an affordable price. There's three types of loans that are backed by Uncle Sam, each with unique requirements to qualify. First is the FHA loan, which is backed by the Federal Housing Administration. This loan is for individuals who don't meet the requirements for a conventional loan based on credit or money for a down payment. FHA loans require a minimum down payment of 3.5% and a minimum credit score of 580. Using the numbers from before, 3.5% of $430,000 is about $15,000. Don't get me wrong, that's still a lot of money, but for most people, it is more doable. And if I'm being honest, you can find a really nice starter home in a decent area for under $250, unless you live in a more expensive part of the US. The major downside to FHA loans is that they have mandatory mortgage insurance, making the overall cost of the loan higher than a conventional loan. They also have borrowing limits in most areas, which limits the available housing to buyers. The second government-backed loan is the USDA loan. Backed by the U.S. Department of Agriculture, these loans help borrowers buy homes in rural areas. These loans are great because they require no down payment or mortgage insurance. They do, however, have an upfront 1% fee and an annual fee, but these can be added to the loan so you can still avoid a down payment. These loans are mostly for lower income borrowers, and there are income limits to obtaining them. The last government-backed loan is my personal favorite, the VA loan. Provided specifically for service members and their families, the VA loan is a flexible option that often beats the interest rates of a conventional loan. There's no required down payment, mortgage insurance, or minimum credit score. Closing costs are also capped. The VA loan does have an upfront funding fee that can be as high as 2.3%. This can be financed into the loan though. The fee can also be waived for veterans with disabilities. Personally, I love the VA loan. Every house I've had has been under a VA loan at some point. In my opinion, there's no better deal out there for the average person, and I honestly believe that the VA loan was a major contributor to my financial success. The major and obvious downside of this loan is that you must be a current or former member of the military or their spouse. All the government loans have an owner occupancy requirement, meaning that you have to live in the house for at least a year. This is also the government we're dealing with, so added paperwork is pretty much inevitable. These loans are good for individuals who may have trouble qualifying for conventional loan or veterans who want to take advantage of their VA benefits. Next, let's talk about fixed and adjustable rate mortgages. A fixed rate mortgage is a loan that carries the same interest rate for the life of the loan. These mortgages come in 15 and 30-year terms, with the most common being a 30-year fixed rate conventional loan. Fixed rate mortgages are great because they offer predictability for the buyer since the principal and interest never change. The downside, of course, is that if interest rates decrease, you'll have to refinance to get a better rate. With rates being their highest in over a decade, I can see that scenario happening. Fixed rate mortgages also tend to have higher starting rates than adjustable rate mortgages, or ARMs. On the topic of ARMs, these loans are in direct contrast to fixed rate loans. ARMs offer a fixed introductory rate that can fluctuate after the initial term based on market conditions. The most common ARM is a 5-1, where after 5 years, the rate can change monthly. These loans are good for people who want a lower interest rate initially and intend to sell or refinance their house in the near future. This comes at a major risk though, as this could make the mortgage unaffordable and the house value could dip to the point where sale or refinance isn't an option. You should carefully consider your options and read the fine print when selecting an ARM. Selecting the wrong loan is one of many mistakes you can make during the mortgage process, but I walk you through 5 of the most common mistakes in my next video, so be sure to subscribe so you don't miss it or any of my other content. My goal with this new channel is to arm you with the info you need to level up and take more control over your life. Till next time, thanks for watching.